Hey, what's up, guys? My name is Frank Mularcik. I hope you guys are having a great day today. And today we're going to be talking about how to start investing in 2021 and exactly what I'm doing to sort of start a new portfolio, a dividend investing portfolio from the ground up. So we're going to discuss that, and we're going to discuss, is it even a good time to be investing right now? And short answer for me is yes. You should always be investing, and the saying is time in the market beats timing the market. So that's what we're going to discuss today. If you do enjoy these videos, make sure to like them to show your support, and also subscribe if you haven't already. It really means a lot to me that you guys are taking the time to watch this video. I know there's a lot you could be watching, so I just want to thank you for that. So one of the things that investors often look at to determine if a company is undervalued or overvalued, or the market as a whole, is the PE ratio. And the PE ratio stands for price to earnings. So basically you take the stock price of a company, and divide that by the earnings that a company produces in a calendar year. Obviously, if the price of a company goes up drastically, then the PE ratio would go up. And likewise, if the earnings of a company go up drastically, then that means the PE ratio would actually go down, because there's a larger number in the denominator there. So people will often say that smaller PEs or lower PEs tend to indicate that a company may be undervalued, and higher PEs could indicate they're overvalued. And you can apply this general principle to the overall market by looking at the PE ratio of the S&P 500, which is what we're going to do right here. So this is a chart of the PE ratio of the S&P 500 since basically the 1930s. So as you can see, throughout most of history, the PE ratio has been trading, around 15 to 25, I would say. That's sort of that median range that it is most of the time. You can see back in the 1950s, it was way down here in the single digits, and again in the 70s, it was like that in the 80s. But recently, since the last maybe 30 years or so, I would say the PE ratio has generally been a little bit higher. And you can see this big spike here, which was during the dot-com bubble of the early 2000s. Then this huge spike here was during the financial crash in 2008 and 2009. And then right now, we are at this current pandemic crash, and the PE is about 38. If we zoom in here to a more recent time, we can get a better picture. And right now the PE is about 38. And during the financial crisis, the PE was 120. So we're actually going to take a look at this, and there's some interesting data here, because most of the time people will say that a high PE indicates the market is overvalued. But when you look at these values, you can say the highest PE during the dot-com crash was right around December of 2001. So if we look at the S&P 500 graph here, and we go back to about December, this is right around December of 2001, we can see that the S&P 500 was right around these levels. It had already crashed a decent amount, but it still had a little bit more to crash. So it was fairly close to the bottom of the market when that PE ratio was at its highest, which is interesting to look at. And then we're going to look at here during the great financial crisis in 2009. In about May of 2009, the PE was at 122, which is insanely high. So if we look at the S&P 500 during that period, during May of 2009, the market had just crossed over from the bottom, and it started going up a little bit more. So at that point, it was very, very close to the bottom. So that's really interesting to look at. And the reason for that, even though the prices are so low, is that basically the earnings of these companies has fallen drastically. So that means the PE ratio is going to be much higher. And there might be arguments that the current PE situation is different, because the earnings of these companies haven't been hurt all that much in a lot of cases. And the prices are just overvalued. But I think that is an interesting take, and maybe an argument why you should continue investing no matter what. Because if you had said in 2009, man, this PE ratio is too high, I'm going to sell out, you would have missed out on all these gains, up in the 2010s like throughout all these years. So that's just something to think about, and why I think you should always be investing consistently, maybe cautiously, but consistently. So obviously this decision is for you to make, but let's just say for the sake of this video that you've decided that you would want to start investing now. So what would be the next step to take? And I think the best thing you can do when you're starting out investing is just to look around you and find products you use, find products you like, and services you might use or like, and find out what companies make those products or provide those services, and consider investing in those companies. Now, that doesn't mean that you should just blindly invest in companies you use, but that could be a good starting point to look at companies that you might want to invest in. Then after you find maybe a list of 5 or 10 companies, you can start doing some actual research on the financials of the company, how the company has performed in the past few years. And one of the also most important things, I think, is finding out how the company makes money, because sometimes we have this perception of how a company may make money, and a lot of times that really isn't the exact correct notion that we might have. So I think it's really important to learn how a company makes money. So once you've come up with a decision of companies you want to invest in, then you have to decide at what price you want to buy them. And this is where it gets tricky, because some people might say you should just wait until you get a very attractive price to invest in a company, and some people might say you should just slowly invest over time, which is called dollar cost averaging, and then eventually if you pick good companies, then you'll have good returns because that company will continue doing well, and you might not have the best return possible, but you would still have a pretty good return. So my strategy is kind of a combination of the two, I would say, because I definitely, when I'm investing, I try to look for companies that I want to add to, and of those companies I want to add to, I will try to find some that I think maybe at a bit of a discount or maybe a bit undervalued. But I do like to make sure that I'm consistently investing. Usually I try to make some sort of investment every week, even if it may not be the absolute best deal, or at least at the bare minimum every 2 weeks to do something in the market. And I do want to stress that my strategy is a long-term buy and hold strategy. And so for me, I'm not really too concerned if I don't get the absolute best price a company may be trading at, because in the long term, I have confidence that these companies will continue to do well and continue to grow in stock price and pay me dividends. So the portfolio I've been alluding to that I've been starting this year has actually been some investments for my brother, and he's had some definite experience in the market. He has some experience with actual stocks themselves, but it was mostly like swing trading and day trading type stuff, and like a little bit of penny stocks, I think. So he doesn't really have a ton of experience with like dividend stocks, which is what I mostly invest in. So he asked me to basically help him. So right now I'm buying some companies for him, but I'm also making sure to talk about like why I'm buying those companies and how I'm researching them and stuff. And so I'm just trying to build his knowledge up by helping him along the way. So this right here is basically the transaction history of what I've been doing over the last 2 weeks. So he actually did have 2 shares of Apple that he bought sometime in September, and he actually bought them at pretty much the worst price, pretty much at an all-time high, but that's fine. I think over time Apple will definitely do awesome. And then I just put this cash in here just for ease of numbers, I guess, to make the accounting a little bit easier, because this isn't the exact amount he deposited, but that's basically the amount I had to work with when I started working with his account. And then below that, these are basically all the purchases I've made. So you can go through Air Products, the chemicals. I just thought that was a good price. And then JP Morgan, I'm really happy with this decision to buy into some JP Morgan for him. I actually wish I had bought a little bit more, because basically JP Morgan announced a share buyback program for 2021, which they announced $30 billion that they would be buying back of shares this year. So already JP Morgan stock has been doing great over the past 2 weeks. I'm sure it's not going to continue on that really quick appreciation, but I'm sure they will continue doing well this year. So that's why I wanted to start a position with them. And then Southern Company, again, they were just under $60, so I thought that was a good price, at least to start a position. Not the very most attractive price, but a good price to start. And then Coke, they have been trading down the last few weeks or so, and as you can see, actually made another purchase the next day when they dropped under $50. So I think they're even a little bit lower now, so I might get even more next week, but we'll see on that. And then Microsoft, they were under 215, which obviously I think that's still a bit higher than I would like to be buying it, but I just wanted to start an initial position in Microsoft and see how that goes. So we did start that out there. And then Realty Income, last week, I think they announced not a share buyback program like JP Morgan, but actually they're going to be selling more shares. So on that news, basically the stock dropped 5 or 10%, I think. So I did grab some shares there, about $100 worth. And then, like I said, I bought some more Southern Company, even more, under $60, under $59 actually. That was a pretty good buy, I think. And then I did grab some AT&T. I thought it was at like $28.50, but it looks like it was at $29.06, or maybe the price just fluctuated a little bit right when I bought. I'm definitely trying to take it slowly, just because of how overvalued the market seems. But like I said, you really don't know at all what's going to happen in the future, but I definitely want to be cautious as to how much I'm investing and keep some cash on the sidelines. He is going to be depositing like a certain amount every month into this account as well, but I definitely don't want to use up all the cash balance immediately. So I'm just trying to take it slow and take it day by day. So this is what his portfolio is looking at so far. The total value is right under $1,900 with some dividend income of $12.59, which obviously is not good at all for a portfolio of this size, but only around $400 of that is invested, I think. So we still have a cash balance of $13.69. So the dividend yield is right here, 2.4%. And most of the reason it's so low, honestly, is just because of those 2 shares of Apple, which yield only 0.6%. So, but over the long term, I think Apple will be great, and the beta is right under 1.97 basically. So it's slightly less volatile than the overall market, which isn't a huge deal. And then that average 3-year CAGR, I was really happy to see it was 7.99%, which is really good. As you can see, JP Morgan, since they did cut their dividend following the financial crash, basically, they've been raising it aggressively, I guess. So that is contributing to some of that good metrics, or some of the reason those metrics look so good, I think. But some of these other companies have some pretty good growth metrics as well, such as Microsoft and APD. Right now, I'm just looking at companies that I think are a super great price, and I'm not trying to worry about the long-term dividend CAGR too much. But in the future, once I have some positions started and I'm just looking to build up positions, I will focus more on that CAGR, I think. And then just looking at the sector, obviously it's mostly in cash, and then technology, because of those 2 Apple shares, is the vast majority of the rest of the investments. And then real estate is actually next up with about 5%. And then the dividend income, it's actually pretty spread out. Real estate's definitely the biggest, and then the communication services. And because of those 2 shares of Apple, technology looks like it's a fairly big chunk, but for the amount invested, technology is not a big chunk at all. So that's what I'm doing with this new portfolio in 2021, and my tips and strategies for dividend investing in 2021. If you guys do have any questions about this, leave them in the comments below, and let me know actually if you want to see some updates in the future from this portfolio, just to check in and see how it's going. But I really appreciate all the support you guys have been giving me, and I will see you in the next one.